Most people want to invest, but the moment they open an app and see a wall of tickers, charts, and numbers, they freeze. It feels like a world built only for experts, not real people with normal lives. But what if the simplest path is actually the most powerful one? What if you could build a serious long-term income stream using steps that feel natural and easy to follow? In this video, I'm going to show you and John how to build a dividend portfolio from scratch, using simple language, real examples, and a structure anyone can follow. I'll show you the basics of what a dividend portfolio is, the different strategies you can use, how to choose stocks without stress, and how to build a clear structure that compounds without losing sleep. And in the end, I'll show you something most tutorials never talk about: how a tiny $5 a day habit can grow into a portfolio worth $1.6 million that pays over $8,800 a month in dividend income. But before we get into the stocks or the step-by-step process, there's one essential mindset shift we need to talk about first. Most people run into trouble with dividend investing long before they ever buy their first stock, and it usually comes down to mindset. Beginners think the goal is to guess the right stocks or wait for perfect timing, but dividend investing works differently. It's not about predicting the market. It's about building an income stream that grows while everything else moves around it. Think of it like taking care of a small plant. For the first few weeks, nothing seems to change. You water it, check on it, and it looks exactly the same. But beneath the soil, the roots are forming. That early stage is where most people give up because the results aren't visible yet. Dividend portfolios grow the same way. Early payouts feel tiny, almost symbolic, but these little contributions are the beginning of something much bigger. Another common mistake is focusing too much on price instead of cash flow. Prices bounce around daily, but dividends are based on long-term profits, not short-term emotions. Shifting your focus from "is the price up today?" to "is my income growing this year?" makes the whole process calmer and easier to stick with. Look, once you think like an owner instead of a trader, everything becomes far more logical. And now that the mindset is in place, let's make the whole picture clearer by breaking down what a dividend portfolio actually is in the simplest way possible. A dividend portfolio can sound complicated at first, but once you strip away the intimidating language, it's honestly one of the simplest ideas in investing. A dividend is just a company sharing a portion of its profits with you because you own a small piece of that company. That's it. If a business earns money and chooses to reward its shareholders, you receive a little payment simply for being a part of the team. No trading, no timing, no jumping in and out, just ownership and participation. The easiest way to think about it is this. Imagine you and a few friends own a small bakery together. Every few months, after covering costs and saving enough to grow the shop, whatever profit is left gets divided between everyone who owns a slice of the business. If you own a little, you get a little. If you own more, you get more. That's exactly how dividends work. The only difference is you don't have to bake anything or show up early in the morning. Now, the amount a company pays is called the dividend yield. If you put in $100 and it pays you $3 a year, that's a 3% yield. But here's where people sometimes get confused. That percentage changes as the stock price changes, even if the company's payout stays the same. It's not like a fixed interest rate. It's just a simple snapshot of what you earn compared to what the stock costs right now. Most companies pay dividends every 3 months. I like to think of it as getting paid every season: winter, spring, summer, and fall. Each one comes with a paycheck. Some companies pay monthly, but quarterly is the most common. And as long as the business keeps making money, those payments keep coming without you doing anything extra. Once you see it this way, a dividend portfolio becomes much less mysterious. It's just a collection of businesses sending you regular, predictable payments because you're a part owner. But here's the fun twist. Not all dividends behave the same way. Some stay flat for years while others grow over time, and choosing the right kind of dividend is what shapes the entire future of your portfolio. So in this next step, let's break down the different styles you can choose from and how they can completely change your long-term results. Choosing the right dividend strategy is one of the most important decisions you'll make because it shapes how your portfolio behaves both now and 10, 20, 30 years from now. And the interesting thing is that most people don't even realize there are different styles of dividend investing. They just see a yield percentage and assume higher must be better, but that approach is what gets many beginners stuck with portfolios that look good today and disappoint them later. There are three main styles to think about: high yield, dividend growth, and a blended approach. High yield is exactly what it sounds like, big payouts right now. It feels exciting because the income looks impressive up front, but here's the catch. Many high-yield stocks barely grow their payouts over time, and some can even cut their dividends when the business slows down. It's kind of like choosing a job that pays well today but never gives you a raise. The income stops growing, and the long-term potential is limited. Then you can have dividend growth. These are companies that might start with smaller payouts, but they increase them consistently year after year. In the beginning, it won't look dramatic, but 10 or 20 years later, the cash flow can be much bigger than anything a high-yield stock could have offered. This is the style most long-lasting, gigantic portfolios rely on, simply because growing payments become a compounding engine on their own. The third style is a blended strategy, a mix of both. A few stronger yields for income now, combined with reliable dividend growers that scale your income later. Most investors end up here naturally because it feels balanced and flexible, and it also helps the emotional side because you get some income today without sacrificing tomorrow. It gives you stability while still letting your future income snowball in a meaningful way. So now that you understand these three approaches, a new question naturally comes up. How do you actually pick the right dividend stocks without drowning in research or feeling overwhelmed? That's what I'm going to show you next. And in the end, I'll show you how a portfolio built from those stocks can turn a $5 daily investment into roughly $1.6 million and pay more than $8,800 a month in dividend income. But first, let's see how to pick dividend stocks without getting overwhelmed. A lot of people never move forward because the selection process feels too complex. Mostly because there are thousands of companies out there and everyone seems to have a different opinion. But when you strip away all that noise, choosing solid dividend stocks is much simpler than it looks. You don't need to dig through endless spreadsheets or read complicated financial reports. You just need a few clear signals that tell you whether a company is stable, profitable, and likely to reward you over time. The first signal is understanding the business. If you can explain what the company does in one or two sentences without using any fancy language, that's a good sign. Simple businesses are often the most reliable because their profits come from everyday products people continue buying year after year. Think of things like snacks, cleaning supplies, or basic household items. If the business model is easy to grasp, the dividend usually feels more predictable and less tied to market drama. The second signal is consistency. Look for companies that have paid and increased their dividends for many years in a row. You don't have to memorize charts, just notice the pattern. A company that raises its payouts through recessions, market dips, and unpredictable economic cycles is often one that takes shareholder returns seriously. When you see a long, steady history of dividend growth, that usually means the business has a strong foundation behind it. The third signal is profitability. A company can't pay dividends if it isn't making money. You don't need to know every detail of its financial statements, but a quick glance at whether the company earns steady profits or has a long track record of generating cash is enough to give you confidence. Stable profits usually mean stable dividends, and stable dividends lead to stress-free investing. A lot of beginners worry about picking the wrong stock, but the truth is that most strong dividend portfolios aren't built on perfection. They're built on reliable choices held for a long time. If the business is simple, consistent, and profitable, you're already far ahead of most new investors, and honestly, ahead of many experienced ones as well. Now that you know how to separate solid dividend stocks from the overwhelming sea of choices, the next step is to put everything together into an actual portfolio. Building a dividend portfolio step by step is a lot like putting together a meal. You want something filling at the center, a few solid sides that complement it, and then maybe one piece that adds a little extra flavor or excitement. When everything works together, the whole plate feels balanced. When it doesn't, you end up with something that's either too heavy, too bland, or too unpredictable. A dividend portfolio works exactly the same way, and once you see the structure, it becomes much easier to build one that grows steadily over time. The foundation of your portfolio is the part that keeps everything steady. This is where SCHD comes in. It's a diversified dividend ETF filled with stable companies that have a long history of paying and growing their dividends. Think of it as your main dish. SCHD does a lot of the heavy lifting automatically by spreading your investment across reliable businesses. You're not relying on a single company, and you're not stressing over picking a perfect winner. It lowers volatility, reduces risk, and gives you a dependable base that quietly compounds year after year. So once that foundation is set, you can start adding your dividend growth engines. These are individual companies with strong cash flow, predictable earnings, and a history of raising their dividends. In your portfolio, that includes ABBV, Home Depot, and Tractor Supply. Each one brings something slightly different to the table, but they all share the same core strength: they grow. ABBV has increased its payouts through market swings and industry cycles. Home Depot benefits from long-term trends in home improvement and housing. Tractor Supply grows by serving everyday needs in rural and suburban communities. And then there's the booster, the piece designed to give your portfolio a little extra acceleration. That role goes to AGM. It has a strong historical dividend growth paired with impressive share price appreciation. Now, before we move on, here are the actual metrics for each stock. Things like the current dividend yield, the dividend growth rate, and the average share price appreciation. I'm showing them on screen so you can see exactly what they look like. You can collect the same numbers yourself from any reliable stock research website. It's all public information and really easy to find. Because this portfolio uses equal contributions, the way we calculate the portfolio dividend yield is really simple. We're basically asking, on average, what yield am I getting across all of these stocks? Since the same amount of money goes into each position, each stock counts equally in the math. So we just take the dividend yield of every stock and average them out. In this case, SCHD has a yield of 3.8%, ABBV is at 2.97%, Home Depot is at 2.48%, AGM is at 3.59%, and Tractor Supply is at 1.64%. If you add those numbers together, you get 14.48%. Then you divide that total by 5 because there are 5 stocks. This gives you about 2.9%, and that is your portfolio's overall dividend yield. You can follow this exact same process for the other metrics too. For dividend growth, you average the growth rates for each stock, which gives you a portfolio dividend growth rate of 16.71%. And when you average the share price appreciation numbers, you end up with an overall expected price appreciation of 13.17%. With your portfolio built, the next step is understanding what truly makes it grow over the long run, and that is reinvesting your dividends. Reinvesting dividends is where the magic of this whole strategy really begins. Buying the stocks gets things started, but putting your dividends back into more shares is what makes your portfolio grow in a way that feels almost unfair later on. Every reinvested payout adds a tiny new worker in the form of a new stock to your team, and that worker earns its own dividends, which buy even more workers. That cycle is where the real acceleration comes in. Think of it like a snowball rolling downhill. At first, it's small, But every turn adds another thin layer of snow, and eventually that little ball becomes something heavy and powerful. Dividend portfolios grow the same way. Early progress feels slow, but once reinvested dividends start stacking up on top of each other, everything picks up speed. And when you combine reinvesting with a small, steady contribution habit, the snowball grows even faster. The next thing you naturally wonder is, well, what does this actually turn into over time? So let's look at the full projection. You don't need anything complicated to automate this. Setting up a small recurring contribution, something like $5 a day or $35 a week, is enough to create steady progress. It barely shows up in your budget, but it has a huge impact on your long-term results. And when you combine that with automatic dividend reinvesting, your portfolio grows whether you're watching it or not. The system does the heavy lifting while you simply stay consistent. Now, here's where everything connects, because I want to show you what this looks like using your actual portfolio metrics. With a daily contribution of $5 after 1 year, you would have invested around $1,825. This sets the stage for future growth. After 10 years, the portfolio is projected to reach about $40,368. By then, the snowball is clearly forming as reinvested dividends start adding real weight. But the real transformation happens over the long stretch. After 20 years, this simple routine grows the portfolio to roughly $254,536. And by 30 years, the projections show a portfolio valuation of about $1,623,687 in total value. That's life-changing growth for many. The income side is just as powerful. After 30 years, your portfolio is projected to generate about $106,398 in yearly dividends. That's roughly $8,867 per month. That's income that can cover major expenses, give you real flexibility, or serve as a safety net you built over decades. And when you look at the breakdown, the total value to your invested amount adds to about $1,568,937, of which $1,033,345 comes from capital appreciation and $535,592 from reinvested dividends. Want to know the fastest way and the investment amount you need to reach $3,300 a month in dividends? Click the video on the screen to find out.